Hey guys, what's up? It's Ryan and welcome back to the channel. Now, if you're like me or if you've been watching the news over the last 24 hours, you might have seen that the market took a tumble. So today, we're going to be going over exactly what happened, what caused it, and what you can do about it. Alright, so on Monday, the market fell by more than 900 points before recovering slightly towards the end to finish down 766 points. That means that the market finished down 2.9% for the day. That is the biggest drop year to date. In addition, the other major US indices also fell by around 3%. This was caused by China devaluing their currency, the yuan, in retaliation for an additional 10% tariff levied by the US government on all Chinese goods, set to take effect September 1st. This all occurred on a Monday following the worst week for stocks in the year. So we had the worst week of the year followed by the worst day of the year yesterday. The Chinese devalued their currency, the yuan, in an attempt to make Chinese goods more affordable to American consumers, thus negating the additional 10% tariffs levied by the US government. Now, I'm sure you looked at your own portfolio over the last 24 hours and said, holy crap, what am I going to do? I'm losing a ton of money. Now, the most important thing that you can do in this type of a situation is not to panic. I'm going to repeat that again. Do not panic. Some terrible investing decisions have been made by some great investors who act on emotion, who act rashly, and do not logically analyze the situation and approach it pragmatically. In fact, statistically, most portfolio decisions made on emotions end up causing much more harm than good. The second thing that you can do is analyze your portfolio, specifically the amount of risk you're taking. Look over your portfolio for positions such as penny stock, small and mid-cap stock, which all tend to move much sharper when the market is volatile due to their market capitalization. Market capitalization is the amount of shares that are currently being traded. Because of their smaller amount of shares, small, mid-cap, and penny stocks move much more volatilely. Alright, the third thing that you can do is not to try and time the market. A lot of people think that the stock market can be timed accurately, meaning that they know exactly when to jump in and jump out of the market. Guys, this is a terrible tactic to use when managing a portfolio because it involves getting two decisions consistently right, when to jump in and when to get out. It's very difficult to make those decisions precisely every time and get them exactly right, and what you'll end up doing more often than not is causing yourself greater loss over the long term while trying to time the market. They always say hindsight's 20/20. The fourth thing you should consider is that if this level of volatility, meaning these swings in the market, is too much for you to handle, then you should honestly consider lowering the risk of your portfolio. Start looking at assets such as bonds and decrease your exposure to risk-on assets such as stocks like the ones we previously discussed in number 3 or any stocks that you have. The fourth thing you can do is consider lowering the risk of your portfolio. That means a move to more conservative asset classes like bonds and away from more aggressive or risk-on asset classes like stock. I'm not saying to do this right now and sell at a loss. I'm just saying to come up with a game plan now, earmark a couple of positions that you have identified as risk-on positions, and consider moving to more conservative holdings such as bonds. Once the volatility dies down, you can then consider making these moves and resculpting your portfolio to be a more conservative asset mix. As I discussed in my previous video, Are We Heading for an Economic Collapse? Consider adding non-market correlated securities to your portfolio. ETFs such as multi-sector bond ETFs, merger and acquisitions ETFs or M&A, and also hedge replication ETFs can all be utilized to give an element of non-market correlation to your portfolio. You can also look at adding whole life insurance policies from solid mutual companies, CDs or certificates of deposits, and government and muni bonds to your portfolio. All three of these will also help to make your portfolio less correlated to the market. A word of warning out there to all investors who are considering inverse index ETFs or leverage volatility ETFs. There are many ways to make money in a down market, but these specific instruments are not meant to be held long term. They are actually meant to be traded intraday, meaning not held longer than one day, but just know they are not designed to be held long term. The last thing you can do is watch my video on economic collapse, which goes into greater detail as to why there are greater underpinnings to this market volatility than simply a trade war with China. All right, those are my tips and tricks for how to survive market volatility. So, to recap, 1, don't panic and sell. 2, don't make any rash decisions. 3, consider lowering your risk level in your portfolio. 4, look at alternative and non-market correlated securities. And last, speak with a financial advisor who knows your situation and can advise you based on your goals. As always, guys, thank you so much for watching the video. I hope you found some of this helpful. If you did, please like and subscribe and turn on the notification bell. That helps my videos get out quicker to new people that may not be aware of the channel. And as always, I have left links in the description. If you'd like to check out any of the gear that I use to film my videos, please use the links, check it out. I love the gear that I have. It works fantastic. See you in the next video. Thanks again.